In its order dated June 23, 2022, the Bombay High Court directed Maharashtra Pollution Control Board to grant permission to hikal to restart manufacturing activities at its Taloja plant. Remember, MPCB had earlier ordered the closure of the Taloja plant following a probe into the disposal of a chemical called sodium hydrosulfide at Sachin GIDC that led to a few casualties. Post the reversal in the MPCB order, the said plant got started in early July 22. It removes a key factor which impacted hikal's Q1 FY23 results. We take a closer look at the investment case post the legal update and management commentary and guidance post Q1 results. So what is the legal point of view? The observations in the Bombay High Court order suggest that the disallowance by MPCB to restart the plant was unwarranted, particularly when MPCB had already reached to its satisfaction that hikal has taken corrective measures in the Taloja plant. Apparently, corrective measures required were with respect to manufacturing of phenamidone and its byproduct sodium hydrosulfide within limits. It also implies to obtain affidavit from vendors stating that the byproduct purchased from the company was used as raw material in their respective industries. And the transportation of chemicals should be self-monitored through web-based GPS tracking system. Management mentions that post the legal win at Bombay High Court, the Taloja plant is expected to scale up gradually over the rest of the fiscal. Having said that, the matter is still sub judice. There is one writ petition pending with the Gujarat High Court and the National Green Tribunal has to decide upon the compensation for people impacted by the incident along with environmental compensation. The joint committee appointed by NGT has recommended a total of 17.2 crore as compensation. Hikal's Q1 FY23 performance was expected to be weak due to closure of Taloja plant, which accounted for 15% of total sales and nearly 30% of crop protection business during normal operational days. However, Q1 performance was also impacted by inventory correction by the clients in the pharma business, which was 59% of Q1 FY23 sales. In fact, pharma business reported segmental loss at EBIT level due to significant increase in input costs, coupled with a lag in passing the increased cost to customers. Lower operating profits, higher depreciation on account of asset additions, and marginal increase in finance cost resulted in a loss at the net level. FY23 is going to be a year of consolidation for hikal. In the subsequent quarters, crop protection business is expected to scale up gradually as the Taloja plant is operating optimally for all three shifts. The good part is that the company has not lost any customers or contracts since the environmental compliance incident cropped up. The company is witnessing increase in inquiries from existing as well as new customers for potential collaborations. This is also supported by indications from existing global customers for higher growth targets for the next financial year. In the pharma business as well, a large part of the excess channel inventory has been consumed and the second half of FY23 is expected to be a normal operating period. Nevertheless, on account of a weak Q1, FY23 top-line growth is at best expected to be flattish. Furthermore, the company has commenced process development for a multi-year animal health project with a leading global innovator. Hikal aims to complete the animal health plant commissioning at Panoli by the end of FY23 and start validating products in the following year. Going forward, the company expects 1.5x asset turnover in new capacity additions. Now, this should translate to about 1,000 crore top-line addition by FY26 at peak utilization levels. With respect to EBITDA margins, keeping FY22 as a base, management expects 50 to 100 basis points improvement year-on-year on the margins front from FY24 onwards. Now, taking account of new developments and a possibility of adverse order from NGT, hikal stock is trading close to 9x EV to EBITDA for FY25 estimated earnings, which is at a significant discount to CRAMS or CDMO peers in both pharma and agrochemical space. Part of the valuation discount is expected to sustain in near term due to slower execution record compared to peers and recent management lapses with respect to end-to-end environment compliance and absence of sufficient disclosure norms. We believe the company's growth trajectory can get an uplift from here on compared to 9% CAGR in EBITDA from FY18 to FY22. Perception on management quality is relatively tough to change, but it's not impossible. What provides comfort is the strong US FDA record. Favorable decisions in pending cases should also be helpful. Now, overall, we believe investors with high risk appetite can accumulate the stock given valuation discount, sustenance in clientele, expected improvement in growth profile and increased inquiries for CDMO opportunities. Therefore, we are getting constructive on the stock from our previous neutral rating. Among other key triggers is attraction in opportunities from Japan, which is often seen as a difficult market to crack in both pharma and agrochemical businesses.